Let's break down today's market action, though, with our market panel. Joining us now is Keith Lerner from Truist and Nicole Inui from HSBC. It's great to have you both here. I mean, this was literally a middling day for stocks. I mean, we were higher, we were lower, and we basically have finished the session flat here. Keith, is this the calm before the storm when we have inflation data, Fed minutes, and then earnings kicking off with the banks later this week?
Well, first, yeah, Morgan, great to be with you on this eclipse day. I think a lot of people maybe were watching the eclipse and they weren't focused on the market. It's kind of boring, but I would say boring is good. I think you're right. There's a lot of catalysts coming up. But if we also think about where this market's come, right, we've had 5 straight months that we've been up. The first quarter was up, over 10%. So to me, just digesting and being boring is actually a good thing. And most of these studies that we look at, when we see this really strong momentum that we've seen over the last 5 months, when you look at 6 to 12 months later, the market tends to be up with a high probability. It's not unusual to digest those gains on a short-term basis. That's what I think we're doing. I think the underlying trends are still positive. And I think bull market rules apply. I mean, you stick with the underlying trend and you look at pullbacks as opportunities. And we're likely to see an increase in volatility as the week progresses, as you mentioned. Okay.
Nicole, how do you see this market, especially at a time where strategists have really been playing catch-up with their S&P targets, given the strong start to the year we had with Q1, despite the pullback we've seen in recent sessions?
Yeah, well, I agree. I think the underlying trends are still very positive for the S&P and for equities in the U.S. We're coming up to this first quarter earnings season. Expectations are very low. If you look at consensus, they're only expecting 4% EPS growth for the first quarter. So that's actually a deceleration from what we saw in the fourth quarter. And that really doesn't, combine with what we're seeing on the macro outlook. U.S. GDP continues to be very resilient. Labor markets are very strong. And I think we're having this perfect scenario where we're having strong labor markets, and actually you're not seeing that stoking in inflation pressures. Obviously, this inflation print on Wednesday will be a key focus. But we've always had the view that it's not important when the Fed cuts, but if the Fed cuts. So if we get an inflation print that's slightly higher and that pushes out rate expectations, it's not June, it's July, a little bit later, we think that's still okay for equities. What we'd be concerned on if we get a resurgence in inflation, and then the question comes down to not when, but if the Fed will cut, and we think we're still pretty far from that right now.
Okay, so just to dig a little deeper into that, Nicole, it sounds like cuts are still part of your base case here for the markets in 2024, but you're data dependent.
Yeah, I mean, we're data dependent. The Fed's data dependent. Everybody's data dependent. We still have 3 Fed cuts expected for 2024 and another 3 in 2025. Again, this will depend on where we see these inflation prints. I think the Fed has said that they expect the road for inflation to go down will be bumpy. So I think, if we get a few more bumps on the road, it's okay. It pushes out rate cuts, but it doesn't completely take out rate cuts. And I think that is the big difference for the equity markets. And that's why we continue to stay positive, even with the strong performance we've seen year to date.
Okay. Keith, what do you think matters more? What the Fed does in terms of cuts and what's priced into the market here, or at a time where we've seen multiple expansion, earnings actually catching up to what investors have been doing with stocks?
Yeah, well, our model most of this year has been we would prefer a stronger economy with less Fed cuts than more Fed cuts because the economy is weakening. Now, at this point, the market is, pricing in a little bit less than 3 rate cuts. We've been saying since last year, we thought it was 3. When the market was at 6 cuts, we thought it was 3, maybe it's 2 or 3. We still think it's more likely to happen. But I think the more important thing is if the economy stays strong. Because what you've seen is the GDP estimates, if you think about coming into this year, was around 1%. Now they're closer to 2%. And that's translating into forward earning estimates for this market that are at an all-time high. So I think the one thing, though, just to be cognizant, valuations are rich. It's hard to say what level matters from an equity valuation level. But if the 10-year does start moving at a more volatile pace and moving up, I do think that will create some headwinds, at least shorter term, for the market. So even above 450, I mean, we still think more likely the peak of 5% is a good high for this cycle. But if you start moving up there, I think there will be this tension between those better earnings because, which is actually helped by inflation versus the valuation cap, which will lead to some digestion. But overall, I think a solid economy is a good thing, not a bad thing.